Well, as investors think about what is going to drive the markets in 2024, rate cuts could be one side of it. But the other side of that reflection is, why do we need those rate cuts? Is there a slowdown in the economy? And then marrying that with the fact that the market is currently pricing in some 10% earnings growth that would take earnings to new records. How does that math actually add up? Let's bring in Ryan Belanger, founder and managing principal of Claro Advisors. Ryan, companies have been able to pull the rabbits out of their hats now for some time, defying expectations. Could they do it again in 2024? Are you skeptical?
I'm probably a little bit more skeptical than others. I think really the exuberance we saw in the fourth quarter of markets last year, I think some of those returns were pulled into last year. And I think this year, all eyes will be on profits. The good news is this soft landing is looking more realistic than I probably would have guessed a year ago, and many others the same. Reason being is earnings were down the first and second quarter last year. They were up in the third quarter. And historically, there's only been one other year where that happened, and we still hit a recession. That was 1990, the Gulf War and the S&L crisis. So I think history is on the side of a soft landing. I think there's a lot that still has to unfold here. And you mentioned, how do companies earn their money? A lot of the small companies with higher debts, that's going to be a challenge because they have to refinance those costs at much higher rates this year. So we'll be watching that. That's
interesting because people just think about these lower interest rates relative to last year, but what are they relative to maybe when they took on that debt load, right, in 2020? So that's interesting how you address that, as maybe low rates are not the tailwind that you think it is. What about the labor market? Obviously, there's signs that it's not as tight as it once was. Does that not give a lot of these businesses some levers?
It might. I mean, but from the Fed's perspective, they have a dual mandate. It's rates and labor. And I think they've been forecasting a 4.1% unemployment rate. And, we're not there yet. And the math to get there, we have to add about 100,000 jobs a month. And you saw the print we had on Friday. It was much more than that. So the Fed needs things to cool down. That's why the rates are restrictive, as they've called it. And I think, given that strong labor number, my feeling is they might now be a little bit more restrictive than even just a couple of weeks ago when everyone forecast or read those comments from Chair Powell as being very dovish. I think that was probably premature. If we do get rate cuts, I wouldn't say they're going to happen in the first 6 months of the year.
So then I want to apply that to one particular area of the market, the smaller caps. You alluded to those smaller companies and the refinancings they have to go through. The Russell 2000 had been on something of a tear from those October lows, a little bit of a sharp pullback over a short period of time, now down 5.5%. How do you think about the Russell as sort of a tell and as an area to invest?
Yeah, I mean, we like the Russell 2000, in a asset allocation, but, it really was lagging last year quite a bit. The small caps and the mid caps, too. We can't forget about the mid caps, but, they were trailing the large company performance, and that kind of caught up at the end of the year. And I think what we saw in the first week of trading was some profit taking, some rebalancing of accounts. And, I think people were trying to dig into those indexes and figure out which companies have more debt and which companies are in a much more cash flow positive standpoint. We want to be with the companies that have stronger cash flows, that where the interest rates on their financing costs won't come into play as much on their earnings.
We are taking a look at the price of oil, which is plunging. It's not without its volatility. Is this an area of the market that you've been investing in?
Yeah, I mean, we run balanced portfolios. We have asset allocation, and we are exposed to a lot of different sectors. We haven't had a sector-specific bet to energy or oil. Those who have done very well in the last year or so, and more recently as oil has kind of plateaued and come down. It's a volatile asset class, and I think any investor that's specifically looking to trade on those names just needs to be aware of the risk that comes with focusing on a certain sector.
But within if you are going to play it, how do you look for stability and balance amidst that volatility?
Well, we would like, companies that have very diversified oil fields that are, generating earnings from many parts of the world. the bigger the better, really. If you look at ExxonMobil and Chevron, those are companies that are trading at reasonable earnings, 10 to 12 times earnings. They'll pay you a dividend. It's a good place to kind of hang out. If we do hit a recession at some point, you can at least earn a dividend. But we would, stay away from the more speculative names. Any big name in energy right now is definitely diversifying its portfolio, trying to get into the green economy and expanding ways to get energy. And so I think we'd want to play in those names.